and institutional quality properties, as well as hotel. Mark?
Thank you.
I use Jennifer.
See if I can do two things at once. I appreciate being invited today. It's nice to see a lot of old friends here. I wanted to open up by saying to you that we believe hotel values, for those of you that are hotel owners in the room, will probably peak in this cycle in the next 18 months. And it's because of all the things that Joe talked about, with the ADR growth so high, interest rates are going to be increasing. Amanda and I were just joking, so what are we in China? We're doing 11% annual growth, but we're only going to go down to 8. Probably not going to last forever. So I'm going to hit on 3 subject areas, be up here for about 10 minutes, kind of the fringe areas or different topics that they are talking about. I'm going to talk about Waikiki resort retail, statewide resort retail and real estate, hotel transaction with some specifics in the marketplace, and then cover the resort residential markets across the state. Okay, so Joe was nice enough to already talk about cycles, and everybody in the room here is old enough to have gone through at least 1, maybe 2 cycles. I remember, let's see, when was the first CMBS loan given for a hotel? Maybe 2005? I thought the world had changed. Those guys are, giving loans for that size of properties. It must not be the same kind of cycle. It's a different world we live in. Well, I was wrong. And we found that out in 2007 and 2008. So this is a cycle graph that we do and adjust it every quarter. And I think, we're going to pay particular attention to resort land, resort hotels, and retail in this discussion. So talking about resort retail, king of the asset class is Waikiki. And we're going to talk specifically about rents in a minute here, which are also increasing like many things in Waikiki. But what's interesting is starting in January, we had a half a dozen groups, mostly from New York, approach us about wanting to buy Waikiki retail, whether it's a freestanding building with one tenant or an entire shopping center. And they have deep pockets, or buy whatever size we have here, but they see rents increasing. So like some of you who have been chasing hotels with the ADRs increasing, they're seeing and projecting that in retail rents, particularly in Waikiki. Now, there aren't too many trades because there's a lot of consolidation of ownership or small parcels. When we look at occupancy and vacancy, so this is vacancy, we're at about 6%, and I had to go back to Mike Hamasu, our famous guru, and say, how can vacancy, go up? And we looked through the data, and it really has to do with what's going on in Waikiki Shopping Plaza and Waikiki Business Plaza. If you think about it, there are 3 or 4 major tenants that comprise almost 80,000 square feet. And their movement, depending on when leases are signed and product is available, moves that number. So it'll come screaming back down to below 4% next year. Along with that, rental rates, average rental rates in Waikiki, those of you who are here, know that rates probably go from $3 a square foot to $35 a square foot for prime retail here, have risen dramatically just in the last year. We're also seeing tenants come in and offering lease premiums. So rents for the best 2 blocks of Kalakaua, kind of around International Marketplace, have gone from $30 to $35 per square foot per month. And tenants are offering key money lease premiums, which is basically rent paid in advance. So the market is hot there. This looks at the all the resort markets across the state, and you can see that particularly Maui has made great gains, and I can give you a couple examples of several examples of shopping centers and resorts that we manage that 18 months ago, 24 months ago, were 60 to 70% occupied. They're all at 90, 92% now. So in the better, busier resorts are where your hotels are, Those shop spaces are filling up, the rates are not going up as quickly, but the first thing to do is get the occupancy and get the tenants' sales up. So now I'm going to switch gears a little bit and talk about transactions in the marketplace. This slide shows all transactions. You may not be able to see it in the back, but the blue area is resort and golf. So that's hotels, golf courses, resort properties. And as of the midpoint of this year, that comprises 78% of the transactions by dollar volume. No surprise when that number for hotels is at 1.6 billion. So here's a smattering, if you will, of some of the more known transactions in the marketplace, the larger ones. I think the number is 10 or 11 right now for the year. We probably expect 3 or 4 more to close. There's a couple of you in here that sold some of these properties, and I think you'll be looking very good. It's a very good time to sell. Surprised that I was we thought it was interesting that the buying groups are coming from a little bit different regions. In particular, we've got some buyers from Canada and Singapore, and a little bit from China. Everybody's asking about China. We are seeing Chinese buyers come. So far, it's been the tour operators kind of ahead of the crowd and looking to control real estate to bring their own tours and groups into. They've been bidding a little bit on the low side, but they're here and active and bidding in the marketplace. So I'm going to give you a couple of examples of projects that we're involved in or we're involved in. The reason I selected this one is it shows a fully marketed property. So the information is complete. It's obviously in a location. There was a lot of demand. We had enough time to talk to people. The buyer had complete due diligence. Could have financed it if they wanted to. And you see the cap rate at 1.7%. So there's clearly upside in the rate and in this property for condo conversion. Now to go to the completely opposite side of that would be the non-vote. So the bankruptcy trustee has hired us to sell the property. The information is very imperfect. The condition of the property would be value add, and offers are due in 2 weeks. So this one, we think the buyer is going to be looking for about a 20% return. The first one was 1 to 2%. This one's going to be 20 to 25%, but obviously the risk is there with this. So now I'm going to switch to the resort residential markets. I have to thank Ricky Cassidy for helping us with a lot of this information. I did bring some of our market reports if anybody's interested or you'd like to receive our newsletters later on. So this also talks about the same kind of cycles. And if I can, so you see the bottom of the cycle there, the bottom of the cycle here. This is total resort closings, numbers of transaction and pricing. And when we first started looking at this data for this talk today, we pulled out 2012 stuff, and all of it was not good. It was very flat. Sales were very, very low. And what you're going to see demonstrated in the next few slides is most of the categories have perked up pretty dramatically. So these are overall prices again and trends, and what I would point to is the 30% increase in transactions in 1 year. We'll break those down in specifics. So if you look at resort residential land, so those would be vacant lots primarily for development, for homes, maybe for condominiums. In 2012, there were 63 properties sold. This year, we're projecting 144 properties. That's the slowest of the groups we're going to talk about. One of the trends we're seeing, and we went out and talked to a number of developers in the last couple of weeks, is the finished product, the spec houses, the cottages, the stuff that is fully furnished, has linens and food in the refrigerator is what's selling. So the lots are actually the slowest part of the market. So condominium sales, you see there were 815 in 2012 and 948 projected for this year. So again, the market is getting healthy, and I would suggest definitely on the upswing or in the bottom third versus the hotel market, and not quite as much the retail, the hotel market being at the top third of the cycle. So if you look at single-family homes in the resorts, there were 193 sales last year and 284 this year. So again, that trend strong, telling us that we've come out of the bottom, and in the last 12 months, see a very different market. The biggest growing group is homes over $3 million. So the biggest percent increase. So when you go to Hualalai or Capillo, they're selling a decent amount of homes, whereas 3 years ago, those things were sitting and we were seeing auctions and price reductions. So another section of the market is timeshare. Joe touched on it. It's an important class of product in our resort. We did just happen to put a beachfront property on the market. But what's interesting about this market is there is a market gap. So when timeshare was really hot 5-6 years ago, the major players were financing the construction and the takeout loans for the individual users. That market has evaporated. The best we're seeing now is the major players will put in some slice equity, or maybe 10 to 20%, but the developer and their bank have to come in with the majority of the equity. No one has gone back into that market, and we see that as a real opportunity, particularly on the financing side, to get some higher margin money invested in these markets. So we talked about the real estate cycle, resort land. We have down here just off the bottom, hotels nearing the top. And in closing, I would give you 3 things that we think smart investors are doing right now. One is realizing that their hotel values are hitting a cycle peak, at least in the next 12 to 18 months. Number 2 is to build some spec product in the resort. I think you can get out ahead of it. I think you could build a couple dozen units and be okay. We would build hundreds of units. But that product is moving pretty much as fast as these developers can build it, and they are starting to get a little bit of margin back in that. A couple of years ago, they were building them just to keep their crews busy and not really getting a big profit margin. And the last thing is the timeshare market is lacking, so financing or investment in there is a way to get a higher return. And I'll be around, of course, afterwards. Thanks very much.
Well, thank you, Mark. That's